Everyone, it's Matt Williams with JTM Williams Capital Management. This is the mid-month recap for May 2026. I'm recording this video on Sunday, May 17th, 2026. As a reminder, the ETFs, indexes, and securities mentioned in this video for illustrative purposes only and do not constitute a recommendation to buy or sell. Please refer to the disclosures at the beginning and ending of this video. Let's get started. So the month of May is pretty much continued where we left off April. The S&P continues its ascent here after we bottomed the end of March. Big things I just wanted to go over pretty quickly here today. Breadth continues to be an issue, and there is the breakout or potential breakout in bond yields that I think potentially derail this market advance, at least in the short term. Again, as we can see here, the S&P is continued its ascent. Moving on, I talked about breadth. There was a pretty big, K-shape going on here in the market, let's say since around April 20th, where that's around when the breadth measures started to divert, where it's still continuing to be led by tech, semiconductors, anything related to the AI trade. As we can see here, the percent of stocks above the 20-day, 50-day, 200-day moving average and the bullish percent index all topped out around April 20th and been going down since then. Nowhere can we see that more evident than just in the chart of RSP, the equal weight S&P 500, where, while the S&P 500 is up several percentage points since that date, the average stock is actually down. And as you can see here from the top chart, since we bottomed there at the end of March, the average stock has lagged the S&P quite precipitously. All of that alpha that was generated by being diversified or being in equal weight strategies from Halloween until the end of March, all that alpha is completely gone by the wayside at this point. And as we can see here with tech, again, keep an eye on April 20th. This is when the average stock topped out. Tech, semiconductors, etc., anything again related to the AI trades continue to advance. Let's move on here to some risk appetite ratios. Again, S&P 500 bottom left, the top right. The Nasdaq's continue to outperform. If there are some areas that just may be flashing some warning signals, again, I don't like that consumer discretionary relative to staples also topped out around April 20th. Now, some of that may be because oil has continued to rally. We'll get to that here in a bit. High beta to low vol, continues to, show good relative strength. And credit spreads, continue to really not show much in the way of warning signals here at this point. As I just mentioned, here's the CRB Index. This is a broad-based commodity index. Again, it's just keeping going from bottom left to top right, which moves into the last thing I wanted to cover, which again are bond yields. I've shared this next chart several times here this year. To me, it's probably the most concerning chart, even more so than the 10-year yield, the 30-year yield, and the rest of the bond market, is this chart of this potential breakout in the 2-year yield. And I mentioned that this breakout we had here in March, we had a breakout, a check back, and now we're starting to make a higher high from this reactionary high near the end of March. I look at this, and again, I'm not an economist. It is not my job to be an economist. What I'm concerned about is this type of a breakout after a multi-year consolidation and a breakout this big of a trend line could be, portending to short-term rates having to be, raised somewhere. I'd say when I look at this, probably somewhere between 5 and 5.5%, if not higher. Now, again, the Fed's what controls the short end of the curve. Now, the bond market might force the Fed into hiking rates. Again, not a prediction, but it's probably my biggest concern in the market right now is this chart. We'll move on to bonds with a little higher duration. Here's the 10-year chart. This is the 30. The 30 is right on the cusp of a pretty major breakout. Every time we've gotten close to somewhere in this 5% to 5.15% level, here since October 2023, there's been some verbal intervention from either the Fed or the U.S. Treasury. I do think if we end up having a pretty decisive breakout above this, that there could be a rise in long yields somewhere, again, 5.5%, 6%. That's going to impact mortgages, going to end up impact home sales, could put quite a damper on the economy. And again, now the 10-year yield, which is what has the highest correlation with mortgage rates, it is right there, may have broken out here the tail end of this week. Again, from this downtrend line, same as again with the 2s and the 30s, a decisive breakout, and it could foreshadow going back up to 5% or even higher, which again could be pretty detrimental to the U.S. economy, and depending on the rate of the advance, could be something that could derail the tech AI trade. So I think the big, again, there's the big stories here. Again, the breakout in yields caused by, who knows, again, could be, commodities, could be any number of things. Again, it's not our job to be ask why this is happening. It's happening. Our job is to react to it. And again, what ends up happening with the breadth issue in the stock market is the average stock going to end up digging in and rallying and catching back up to the S&P, or is this going to consolidate sideways or trend lower and tech catches back down to the rest of the market? Again, this is just a quick mid-month recap. Please remember to like and subscribe to my channel. If anybody has any questions, please, I can be reached out at matt@jtmwilliams.com. Hope everyone has a fantastic weekend. And again, look forward to the rest of the month, and I'll be back with a recap of month of May here in a few weeks. Again, hope everyone has a great weekend, a great week.